Hi, everyone. We've seen a significant increase in long-term interest rates, not just in the US, but around the world over the past few months. It became more pronounced over the past few weeks for a variety of reasons. But what you can see here is the upshot since the bottom for the 10-year US Treasury rate at the end of November, right around the time the government shutdown was ending and economic data was starting to flow back in. We've seen what we call a zoo steepening. So that means that there's a bull steepening at the front and a bear steepening at the back. So we had short-term interest rates come down when the Fed cut rates in December. We've had longer term interest rates come back up in a pretty continuous fashion over the last couple of months. This is typically a sign that the bond market is not so thrilled with how economic policy is being run in your country, that we're seeing too much of a drop in rates in the short end of the curve that's going to be harmful to where rates ultimately have to go over the long term. Shorter rates, lower short-term rates today, higher long-term rates in the future. Why is this happening? Well, we often say when it comes to the 10-year rate, the outcome is overdetermined, meaning you can explain using any of these or all of these factors or take any two or three of your favorite ones, and those were all kind of point in the same direction in terms of why interest rates have been rising. We'll go through these one by one in the next few slides. Tariffs have been the big topic of conversation over the last year, really, but especially over the last couple of weeks, with the hinting or the threat of U.S. tariffs on European goods stemming from the conflict over Greenland. Those have since been walked back. And we also had an opportunity this week for the Supreme Court to potentially rule on the legality of the emergency tariffs, and it chose not to do that. So it's now going to be not until sometime later in February that we ultimately get that ruling at the earliest. We did see a spike in interest rates right around the time when the initial Liberation Day tariffs were put into effect. There was a lot of market confusion, disorder. Treasuries were selling off. That was one of the reasons why the tariffs were walked back. So you can see this spike didn't last too long. It came back down in the spring of last year. And that coincides with the period where interest rates starting to be able to decline over the last several months of 2025. So ultimately, probably not much new news on net on tariffs so far in 2026, but the on again, off again nature of some of the threats and the potential for the Supreme Court to rule certainly has had an impact on the 10-year Treasury. More to the point, though, we are seeing individual stories of government bond yields around the world rising for more or less reasons that are specific to those countries. JGBs, Japanese government bond yields, have been going parabolic. They've been rising now for a couple of years, very uncharacteristic, obviously, for Japan, which has had decades of zero interest rates. But we are now seeing the market start to become dissatisfied with the mix of fiscal expansion. Japan canceled some of the potential taxes that could have gone into effect to try to shrink that fiscal deficit that they have. And also monetary policy still being run quite loose. Interest rates there are still below 1% at the very short end. They did raise rates a few times last year, but not as much as expected this time a year ago. They potentially could be raising rates again this year, but they're not doing so in any kind of alarmed or hasty fashion. And that's caught the attention of government bond holders, many of whom are the Japanese government themselves, but there are other private sector holders that are flashing red warning signs to the Japanese government that they need to get their fiscal and monetary house in order. This doesn't necessarily drive treasury prices. There is some correlation, but ultimately this probably strikes fear in the hearts of many other sovereigns around the world that have similar but not yet as dire fiscal imbalances as Japan. Japan has a very high debt to GDP ratio. And you can imagine countries in Europe like Italy, of course, the United States as well, China down the road, having similar issues and having similar government bond revolt, similar to the one that we saw in the UK in 2022. We're also seeing noise around who the Fed chair nominee is going to be. President Trump is probably going to name this person in the next week or so. The odds in the betting markets around who this person is going to be have been varying wildly. Again, this is one person's decision. This is who the nominee is going to be. This isn't even who the confirmed chair will be. There had been thoughts, again, earlier in the year that Kevin Warsh, who was a relatively hawkish former member of the Federal Reserve Board, very conventional pick for a administration that would want to get inflation under control. It's not clear that's President Trump's priority. So Warsh had been seen as a very prohibitive favorite when the president has more or less announced that his economic advisor, Kevin Hassett, is not going to be getting the job. But now you have Rick Rieder, who is a strategist portfolio manager at BlackRock, who President Trump has been saying nice things about. We know he's gone through the interview process. His stock appears to be on the rise as well. And that would be a very unconventional pick, somebody who's not an economist, doesn't have a lot of experience in monetary policy. Hard to know exactly how that would scramble things. But again, the uncertainty associated with the Fed nominee could be keeping interest rates higher than they would be otherwise. And we've even seen a little bit of a tick up in rate cut expectations, which have to do with the quality of economic data, which I'll talk about in a second. But as those short-term rate expectations move up, you tend to see longer-term expectations move up a bit also. Now, keep in mind, in the context of the Fed has been cutting interest rates over the last year and a half. The other thing that we're starting to see is concerns about the upcoming midterm election. Now, those don't happen until November, but we know that the president obviously wants his party to win the midterms. He does not want to lose one or both houses of Congress because of what that will mean for his agenda in the second half of his term. And so a lot of the things that we're seeing proposed tend to be expansionary, tend to be stimulative, dealing with affordability, capping credit card interest rates, having the GSEs, Fannie and Freddie, buy $200 billion of mortgage-backed securities. All of these will add incrementally to the debt or be attempts to stimulate the economy or ease affordability issues associated with households. And that is happening because of the president's approval numbers going in the wrong direction. This has historically been a very good indicator of how the midterm elections are going to go. So as you see these approval ratings come down, disapproval ratings moving up, there's a greater chance that there'll be more fiscal tricks tried in the next couple of months leading up to the election, and also that the arrangement following the election, which could potentially be Democrats controlling Congress, Republican in the White House, that has been a very expansionary mix of government power in the past. You effectively have Congress passing big increases in spending and having Republican presidents more or less have to sign them. We saw this in President Trump's first term. We also saw it in the second half of the George W. Bush administration. The 10-year yield is also being responsive to government data. I made allusion to this when we talked about the Fed cuts being priced out. Why are Fed cuts being priced out? Because economic data has been coming in more or less okay, certainly not indicating that the world is on the brink of collapse. If that were the case, we'd be seeing longer-term rates fall. You're seeing economic surprises comfortably above zero. That's tending to provide a floor on where the 10-year rate will go. We are not in a situation where inflation is driving the 10-year. That was happening in 2022. We had economic data getting worse in 2022, but interest rates moving up. That's just about the worst thing you can imagine happening to an economy. We're not seeing that now. We're seeing more or less as expected, slightly better than expected economic data, and interest rates really not feeling the need to budge one way or the other. But the yield curve is steepening, and that has an effect on the mortgage market. It has an effect on businesses, incentives, and ability to invest. And what we're seeing specifically in the housing market is what had been a pretty hopeful picture on this graph up until the last couple of weeks, because you had mortgage rates falling, that's that blue line coming down, and you had applications for home mortgages for purchase moving up. That had been seen as a potential source of unexpected growth, certainly growth that had not been there over the past couple of years. That looks less likely if this blue line is going to start to move up again. So we'll have a lot more to say about this, assuming the 10-year continues to stay stubbornly high or even moves higher from here. It's potentially going to be a headwind for the economy and for corporate profits in 2026. But we'll obviously keep an eye on that and have lots more for you in the weeks ahead. Thanks very much.